All right. And we are live with Exit Liquidity. Once again, we have Captain Rational in the house.
Hey
And
guys,
the markets, they are pumping.
markets
Everyone
look
is
good.
everyone is making money. Everybody is feeling happy and content. The macro must be at our the macro wins must be at our backs at the moment because the rising tide is lifting all of the boats.
What kind of perverted system are we in where the macro winds are at our backs and China is literally collapsing with a 2008 style real estate meltdown?
You know, ironically, when we were collapsing with our 2008 style meltdown, they were pumping. So it's only fair, really.
I mean, it's really gross. I mean, Japan, the yen is doing crazy stuff, man. It's at 150. It's literally at Japan meltdown mode.
All right. I mean, I feel like we're already into the charts. But hold on, real quick. I kind of want to go to that chart, but look at this. Look at this beauteousness. Uh yeah, so Bitcoin is trying to do its thing. And yeah, we will see if this is you know, if maybe it is doing one of these and then this, or if it is just off to the races.
I want to say something about this chart. Whoever's buying this chart right now, you're not buying at a good price. What does that mean? The good price was 15,000 when everything was crashing. You're buying at the wrong time. This is at a premium. Now that doesn't mean it doesn't run multiples up to $250,000, but I'm much more interested in the bottom. And the bottom, after everything falls out, tells you much more about the market than the all-time high. So the all-time high is probably the most misleading thing to consider with regard to engaging in a market in a sustainable way. It's like, where does it crash? It crashes to what, 60,
Yeah.
65? And that would make sense. Why? Because that's exactly where we crashed to last time. I mean, maybe 10, 15, 20% below 2018 all-time highs.
Yep. Like
So that,
and the thing about bottoms is bottoms are not made with big candles. Uh uh, Big candles are the beginning of the end frequently, but um or the beginning of the big run up, but real bottoms are made down here, like where the candles are just imperceptible. People have just stopped caring. Like the price isn't moving because everyone who wanted to sell sold. Everybody else isn't interested. And volume dumps off the table. Like it's just there is nothing as
so
far
that,
as
that that's the
interest.
thing, though, that it's mispriced because price is to a degree a component of confirmation and confluence, but it doesn't mean everything with regard to a story being confirmed or invalidated. So you have to, that's why it's so much easy. It's an interesting statement I'm about to say. It's so much easier being a robot. What does that mean? A quantitative assessment and determine it's not a conviction is a human thing. We belief something is either more likely or less likely. So what is the likelihood of this entire narrative being invalidated? And that to me, from a quantitative perspective, probably is like near zero. From a subjective perspective, it's this fear. What if it's invalidated? What if everyone's wrong? What if all of this technology means nothing? But that's not the case as a robot. It's near zero that this tech is invalidated as being viable and interesting and meaningful by the bottom. Buy the cheapest price possible. That's what I always say. You want the cheapest price possible.
Yeah.
And is that where we're at? Is it the cheapest price possible right now? No, you're paying a damn premium for everything.
Yeah.
People are late.
Not our viewers. Our viewers would never be late.
Well, folks
they're,
are late to the
so just doing a quick comparison here. So like this little run up here uh after 2017, you know, off the bottom came up like 350%, which what are we at right now? That's a good question.
if you notice, and that's the bottom. It was around
We're
two
at
and
we're
change.
yeah, we're at like 200% right now off the bottom. But I mean, just something to keep in mind that like it's possible this is not the bull run. This this could just be the you know, the beginning where we're putting in a higher low at some point like this, you know. It can happen. I Everybody is bullish going on. And so you know, we will continue to watch and observe. And I mean, I'm still long as can be. So I am
I wouldn't be surprised. Look, that's a rising wedge.
yeah.
And now, obviously, in a bull market, that breaks to the upside, but a rising wedge statistically breaks to the downside.
Now, yeah, when you see rising wedges break to the top, I will buy that chart every time because those things just they tend to break out hard. Like I've never seen a rising wedge that just kind of goes and then it goes up another like 10% and then falls down. If it has the power to break through the rising wedge, it ain't stopping. It's gonna keep going. So
Look at the MACDs. Expand the MACD vertically. So you guys, it's important to understand everyone's late right now. This is not early cycle. If you get so many more multiples at 15K to 250K compared to 50K to 250K, it's just literally another 3x on the money on top of a 5x, which is a 15x compared to a 5x. And that is meaningful. It doesn't mean that this isn't an interesting price. It means it's at a premium. I wouldn't be surprised if we get a capitulation down to support on the rising wedge.
yep, agreed.
And that's really like the entire conversation right now. The destination is the breakout to the upside as liquidity floods the market. And the question is do you have a down cycle first before the breakout, or do you just break out now?
Yeah, that is the question, and I do feel like this is an interesting place to be asking the question, because I mean there are a lot of things going on in the background of the macro world right now, uh, where you could see, I mean, just historically too, like Bitcoin has never really, at least I mean, as long as I've been following it, done too well around tax season, especially after a big run up, um, because people have to sell to pay their taxes.
Yeah, different
So
narrative now with all these damn ETFs sucking supply out of the market where they got $6
yeah,
billion. It's
that's
remarkable.
true. I mean, those ETFs are like each one of those things is like its own little Michael Saylor, and so like those things have been sucking up a lot of Bitcoin. You got the halving coming up, so there's plenty to be bullish about long term. But I mean, we've had a number of big green candles in a row on this monthly chart, so I think it's also fair to ask the question, hey, is it time for this thing to take a breather?
I like to think it doesn't matter.
I,
I like to think
I mean, it really depends on your time frame, because like all of my Bitcoin that sits in my hardware wallet, I didn't sell it at 60. I didn't sell it at 69 or whatever it hit. I didn't sell it at 15. I rode it all the way down, all the way back up. It really depends on time frame. If I was trying to trade this chart like on a shorter time frame, on a like 6-month time frame, I would think about taking some off the table here, but that's not financial advice. I'm just telling you what I would do.
I can't do the trading anymore. You can capitalize and extract multiples. I know so many people that do it so well, but there's got to be a better way, and that's the whole reason I started my stream. And there is a better way,
Yeah.
and fortunately, it's the real the better way is now available again, as indicated by the reversal in rates and the structural change in the macroeconomic environment, which is really the downfall of the debt-based financial system. But what's very notable about that is that takes 10, 20, 30, 40, 50 years. It's
Yeah.
not going to happen quick.
No,
And
it's
there's a
the dollar's not just going to die anytime soon. Maybe not even in our lifetime. It's going to take time.
So you're going to have your higher lows and higher highs on rates, and you have your secular trend change. And that means it's going to get disgusting and gross. And it's going to be really interesting when you have 50 trill in US debt, 70 trill in US debt, 20 trill on the Fed balance sheet, and consumer price inflation is relatively low
Yeah.
because
Well, look at Japan. I mean, to me, Japan is the ghost of Christmas future. They are they are us, but like uh 20 years ahead of us. They started QE before us. We followed in their footsteps for whatever reason. But like basically when the Asian financial crisis happened, that's kind of when they started their their QE, which was like late 90s. Um so I mean, it took us, I guess, another 10 years to do QE after that. Or actually, no, it wasn't the Asian financial crisis. It was after 1989 when the big Japan boom busted. So, I mean, regardless, the path that we're on and the path that Japan has been on is one that has seemed for many years, even decades, unsustainable. And yet
yeah,
here we are, and here they are. They're still here, and they even said something that like they vow to keep their treasury market. What did he say? Hold on a second. I can find this tweet real quick. Hold on. It was entertaining. Japan's finance minister vows to manage debt appropriately.
uh,
Uh, you know, I could just as easily see those words coming out of Janet Yellen's mouth. So it's just you're on this path, and as much as like the macro shock jock types like to say that everything is ending, this is all unwinding right now. It's not. It's not. But it is the path obvious? Yes.
it's as
But
clear as day.
it is clear as day. It is very obvious that this is ultimately heading to a place that
Gross.
is gross. uh
Listen, Japan, if it's a matter of systemic viability and existentiality, and which it is in many regards. If Japan is literally collapsing and they have contagion, and they're like, U.S., we gotta offload 800 bill with a long dated treasuries. At some point, you're talking sovereign bailouts, and it's not even and that wouldn't seem so awkward, or at least that wouldn't affect the real economies uh, to a great extent. Um, it'll change. Moral hazards dead, sure, but all the Fed needs to do is put JGBs on the balance sheet, and now all of a sudden, there you go, because that's confidence. Now there's a floor. The Fed's back in the floor, and it is injecting dollars into the system, which takes the power out of the dollar FX, and all of a sudden that stabilizes Japanese currency and bonds.
yeah, I mean it this thing, there's so many ways to keep this thing afloat. And
Yeah.
this is something Brent Johnson talks about for and has for a long time, that like they haven't nowhere near run out of tools to keep this thing going. I mean, not even including just the invading the people that don't like your price discovery part of the equation that they could do, but like there are so many ways of manipulating markets and keep extending the clock on this clearly unsustainable path. And so
The equation's simple at this point. They're not going to permit chaos and social unrest. Social unrest is always financed, and that's why we got to the place where we are with regard to socialization, social programs, taxation, all these the fiscal policy. It's all about financing social stability, and your closest allies will get bailed out.
yep.
Moral hazard's dead.
But that said, look at this Japanese 10-year chart. Uh, that is a very clear trend reversal there. And they're a little further down the path of unsustainability than we are.
We just
So,
haven't had external intervention yet. The
nope.
destination is the Fed buying JGBs, and then it's just now it's like picking winners at the
Well,
sovereign level.
and to be fair, the Fed already probably has JGBs, because the Fed doesn't have to disclose what they hold their reserves in. Uh, and so I would guess that there's a number of those in there.
So what do they do? It's obviously the case that it's like they're oh it's getting bad. All right, then they put in their intervention, their market activity. It's literally the same thing that people do in public markets. It's
Yeah.
a head fake.
Yeah. I mean, their size is size, so they can move markets. They can make the little fish think that, oh, tide's turning, let's go, jump in.
And by them buying JGBs, that's literally gonna put the downward pressure on the DXY.
Well, and
And
I honestly think that's exactly what happened right here. I think that's exactly what happened right here, is that everybody knew that the dollar pumping like this was extremely dangerous for not only just emerging markets, but like even our highly developed um, friends like Japan and Australia, like all these countries, Europe. I mean, basically everyone other than the United States was having a hard time with this, as we were raising rates, and collateral was getting more and more short. Um, this causes you know problems because we were not issuing treasury bills. Treasury bills were getting scarce. Dollar funding was getting scarce. The dollar was going up, 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 up. Energy prices were going up, 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 and that is a very unsustainable place politically. And so all of a sudden, that stuff just turned on a dime. I mean, some of it was we let loose the SPR, got some black liquidity into the market, and drove energy prices down. I think that was maybe some of it, but I think more than anything, it was some sort of manipulation that was going on between the central banks, where they were buying each other's debt in order to, um, help
collusion.
reliquify those. Yeah, absolutely. Central banks are allowed to collude. You are not. Um,
It's a
so
managed system.
it
Own
is.
assets, turn off your emotions, and buy stuff by defining your own rules where you're able to be consistent and predictable, and then you'll check back. When you get out of college, they say, what's your 5-year plan? Have a 10-year plan. In 5, 10 years, you'll own assets, and it just gets to get really gross, guys. And why is it going to get gross? Because uh, that's the painful path.
Yeah.
And I mean that from a disparity perspective. It's going to get that's what happens in all these countries, in Nigeria and Argentina and Venezuela. It's the folks that own the assets, and everything is protected, so the system remains solvent nominally, and that's
Solvent-ish.
nominal
So
is the politically correct way to say
yeah.
it. Gross, disgusting. Look
Yep.
at the DXY 104, but there's a couple of MAs that are interesting. The
Here's
monthly, yeah.
Speaking of solvency, here's the Fed's
Oh
solvency.
God.
So the BTFP, for those that don't know, it caused well, basically what happened is that the Fed started remitting losses. Well, let me back up. For the longest time, the Fed has always taken their operating profits and sent them to the Treasury on a quarterly basis. Um, Now, back in, I think it was like it was after the global financial crisis. I think it was like 2013 or something. They basically changed the rules that the Fed could kind of make their own rules about. They no longer had a constraint about being, solvent, so to speak. And so they can make their own accounting rules. So instead of remitting uh these payments to the Treasury, they have been putting an item on their balance sheet that's basically, I owe Treasury this much. And that number is now up to $147 billion. And the reason they're not making money is because they've kept interest rates high, and they're paying interest on everything that's in the RRP, the interest on reserves. All of that is making more money than the assets they hold, which the assets they hold are a bunch of like treasuries and mortgage-backed securities that uh best hope they can just roll them off over time. But like, I mean, the average interest rate is probably like around 1% or something. Like it's super low because they bought all this crap uh
At all-time highs.
at all-time highs. And so when your assets are producing 1% and your liabilities are producing 5%, uh you're going to have a bad time. And this right here is the bad time.
It's going to
um
get gross, higher lows, higher highs. You'll see this thing at 1 trillion and then 5 trillion, and that'll be the new Fed balance sheet inspection. This is their debt obligation. But we
yeah.
look at what, 6, 7, 8 trill. We've seen the Fed balance sheet, and we'll see this and go up to a trill, and we'll see the Fed balance sheet go up to 10, 12, 14, 16 trillion dollars, and these,
Yeah.
and that's just the start.
The Fed's
Let's,
I would argue that the Fed is unlikely to ever get back to zero on this particular chart. I
they don't
just
care.
they don't care because they they can make their own accounting rules. And if you can make your own accounting rules, you can do what you want. So
Well, check back when the Fed balance sheet's at $106 trillion, and it's just numbers, and then it gets so gross that they redenominate the currency, where ten
yep,
dollar bills and a new $1 bill, and it's just literally what every country does over and over again, except
yep.
for the U.S. It'll take 10, 20, 30, 40, 50 years instead of 1 year of insanity in an emerging market.
Yep. I mean, it's fascinating to watch this stuff. It's like watching a train wreck in slow motion, but like it's very slow motion. And that is the thing that I think that gets lost so often online when you're reading about these things is that like you see these people on Twitter and on YouTube that are like, the end is here, blah blah blah. This is it for real. And like it just it doesn't work that way. It's never gonna work that way. This is going to be something that happens over decades, not over uh a weekend. Like obviously there can be weekends where the macro gets real spicy
Yeah.
uh, for a little bit, and then and those are the weekends where you learn how they're going to kick the can down the road.
Here's
Uh,
a fun thought. The folks that are doom and gloomers, they're cynical. What am I? I am a whole nother level of cynical. The folks that are doom and gloomers haven't gotten cynical enough, and that they are coming up short on the amount of cynicism required to understand where
Yeah,
we
they're
are.
they're mid curving. They're mid curving the cynicism. They
You would,
know enough to be dangerous, and once you get to the other side, you go, they're gonna
oh,
pervert this thing so badly that I am buying dog coins.
it is beyond. It's done. It's gone. It's not even political collusion. It's political perversion.
Yeah.
It's beyond the point of no return of disgusting, and it will not collapse. Period. Because that's how disgusting it is.
Yeah. I mean, it's going to I don't even think that it'll necessarily collapse so much as just I think that you're more likely to see in your lifetime something slowly usurp this system. And that this is why we talk about crypto as much as we do, because crypto has the ability to be that something that will slowly usurp, because money goes where it is freest, where it can uh you know create the most economic activity. It will flow to those places. And in a world where you just have nothing but a perversion in the incentives, I mean, money tends to flow less
Friction.
towards economic activity than it should and more into degenerate nonsense. But that's a good reason to be bullish on degenerate nonsense. Uh,
Well, money that's and that's why the currency is so perverted. With excess currency supply, you have the potential for this activity. With a scarcity of currency supply, you have hoarding, and you don't, and now you have collection, accumulation, because it's scarce. And that's literally what we're experimenting with in crypto markets is scarce
yep.
digital assets for these types of reasons. But there is an excess supply, but there's an excess supply because that's what the system at this point requires. And frankly, it's interesting. It's not going back, but it's going to produce systems and technologies that aren't possible in a scarce currency regime. Um, so maybe that's like a thought of like the cynicism to take the cynicism out of that and see something interesting coming out of this perverted economic condition. Uh, you wouldn't have this in a gold back dollar regime pre 70s. Um, you just don't have the currency supply to engage in this kind of economic activity.
Right. But well, not in the problem was you had it, but it was reproducing those dollar liabilities overseas. And that is why you got the mad inflation you got in the 70s, is people were learning how to take a scarce asset and make it less scarce by way of borrowing against it and forming liabilities. And I expect nothing different. Like I think it's only a matter of time before people start regularly using Bitcoin and things as collateral. I mean, we already use Ethereum as collateral on chain all the time. But
And
like
LSD
I
is
do I do think that sort of thing, it even if like usually it's in dollars though, right? You're borrowing in dollars. But like there's no reason you couldn't do the same thing denominated in Bitcoin. Like I'm going to take my one Bitcoin and I'm going to deposit that, and then you're going to lend me more Bitcoin, and then I'm going to go do some things, and I'll come back and I'll get my Bitcoin back. And so like you can uh collateral is a wonderful thing.
Bitcoin is going to get rehypothecated more than the gold market ever would be. So maybe when
True.
gold and the GLD ETF came out and it had a run up in price, gold was rehypothecated. It had its inflation and its expansion period. And maybe the same thing is exactly what plays out with Bitcoin.
Yeah.
And then Bitcoin's price ultimately stabilizes. The shorts are able to pile in and stabilize the price, just like gold has
But
experienced.
ultimately, that rehypothecation drives demand because when you owe a currency, you have to buy that currency back to get it if you don't have it. So usually, at least for the last 50 years or so, that's been dollars for people around the world. What happens is when everybody owes a lot of dollars and uh the interest rates start going up and they have to repay those, they have to buy more dollars to repay their loans, and that creates more demand, and it's just a self-fulfilling thing. Eventually you get sort of a blow off top, I guess, and money is sort of destroyed as they're paying those debts back. But it's a process, right? And like you get a natural, like for example, the dollar could never go to zero, right?
It's
Because
always
I don't
worth
know
a
about you,
dollar.
like I I got a mortgage, and before it goes to zero, I'm gonna buy them all and I'm gonna pay off my mortgage.
That's right.
So and there are all sorts of people with tons of debt right now, like
Credit cards are maxed out.
credit cards, student loans, whatever. You all want dollars, admit it. And if the price of a dollar goes to nothing, you're gonna get those nothing dollars and you're gonna pay off your debts and then you'll be free and clear. So there is an inherent demand that is created by owing money in a currency. And so I think probably the most bullish thing that could happen for Bitcoin or Ethereum is having debts denominated in those. And Ethereum already does to some extent on chain, although I think that the majority, I mean, the vast majority of online uh, lending is happening not denominated in Ethereum. Usually, when people borrow ETH, it's only because they're speculating on the price of ETH to go down, and they want to be able to sell it so they can be short. Um, but
It's
usually, they're
dollars.
borrowing stable coins and then buying more ETH or whatever, dog coins, or the latest ERC 404 tokens.
Even when you borrow using Bitcoin as collateral off chain, everyone is still talking in terms of dollars. The dollar is going absolutely nowhere. And just it's get over. Don't mid curve the cynicism.
Yeah, you got to go full cynic.
You gotta
You
go
got to
full
be
rank
so cynical that you become optimistic about everything going up.
because it's either that or social unrest, and they finance the social alleviating social unrest. It's as
Yeah,
simple as
you
that.
you come around full circle. It's like, yep, just buy. It'll be fine. Uh, so thought I would do a quick discussion too, just about some plumbing stuff. Um, so real quick, here's just a chart of the BTFP, which has been kind of taken off. The BTFP is ending in March. I don't know if people have heard of that. For those that don't know, the BTFP is the Bank Term Funding Program. Basically, when Signature Bank and SVB, when those banks failed, um, there was an issue where you had all these banks that had a bunch of 10-year treasuries and various longer duration treasuries that they put on their balance sheets when rates were at the pico bottom. And then the Fed raised a bunch of rates, and then basically all those treasuries got destroyed. And so the thing about bonds is that when you buy them, or notes, is that when you buy them, you are uh you know only going to take a loss on them if you sell them. Like, you might not make much yield because um like a
They were all the HTM portfolios are all-time high prices.
Right. So the HTM means hold to maturity. So there's a special way of accounting for these assets on your balance sheet that says this is HTM, it's hold to maturity. I am not going to take a loss on this thing by selling it. So I am just going to put it in this bucket and I'm going to say that I'm solvent because I'm clearly never going to sell this for a loss. And so the problem that happened was that these banks had all these assets in this bucket, but then needed funding and ran out of things to borrow against or didn't have an account at the discount window at the Fed and just could not get dollar liquidity. And so they ran into a situation where it was either sell these things for a loss and be considered insolvent or
Raise capital, sell equity, or find a credit
or
line.
just or just die because you're unable to meet your deposits.
Do not mid-curve the cynicism. They will find the liquidity.
Well, I mean, yes and no. I mean, it's not that they don't let banks fail. They let Signature fail. They let SVB fail. In fact, it seemed to me that they held off on introducing the BTFP until just after those two had been called dead. I think they wanted those two dead because they were crypto friendly banks. And so they waited until those ones died and then introduced the BTFP. And so then a bunch of banks were able to borrow against these longer dated treasuries at par for funding.
I mean, it's literally 2008 playbook where Lehman and Bear go down, and then they're panicking
Yeah.
when JP Morgan and all the big boys are getting a run on the bank and they throw out TARP. It's literally the same thing, except the difference is the BTFP was spun up over a weekend and TARP took an act of Congress. That's the
Yes.
difference.
I mean, they've become a little more efficient at making these programs because they know how to spin up a new version of QE. Because and there's been a lot of argument about this too on uh about how the like BTFP is not QE. I would thoroughly disagree with that assessment. It was QE. It was a form of QE. You have bonds that were not being sold. Instead of buying bonds with government liquidity, they were not being sold. You were taking, I mean, what is a bond except future dollars, right? You have given the Fed your today dollars, or not the Fed. You have given the Treasury your today dollars, and in return, they are going to give you future dollars at some duration in time, maybe 30 years. So you have set aside those dollars and you will retrieve them, aside from the coupon payments, you'll be able to withdraw the principal after 30 years. Um, so like you have this shifting in time of money. Because what is QE? QE is you buy a bond, you print money, and then you buy a bond with it. So that way the banking system can have dollars now instead of dollars later.
Let's simplify a little. QE is a terminology that broadly means intervention, at least from a Gen Pop perspective. It's where the central bank purchases bonds from the open market for purposes of arbitrage and smoothing out the Keynesian economic system. So your argument is the alleviation of forced selling is an equivalent. If you,
To me, there's no difference between alleviating forced selling and buying.
I agree.
Like it's functionally the same thing, but I do think it's an important concept that like QE is taking future dollars and pulling them forward. That is
How
what
about
QE is. You're buying future dollars in the form of bonds, and you're pulling them into the now by providing liquidity and dollars today.
Simpler, simpler. QE is a bid. Is bid and ask. QE is putting a bid in whatever market they're buying. So what happens with BTFP is alleviating the ask.
Yeah.
So which is a bid, or is the anti-ask is a relative bid.
Yeah.
Is putting supportive pressure on
Yeah.
bond
It
prices.
it is functionally the same as QE. And that is why you saw liquidity increase as soon as this program was put into place. This program is now $164 billion big, which you may recall is nearly the same amount of money that the Fed owes. 147 billion dollars in the hole. Uh, the fact that those two things are nearly identical is not lost on me.
This is where the system is. The system has gotten to the point where these debt instruments, these future dollars, are correlated with risk. Why? Because if you're buying bonds, it means you have excess capital and you don't need the dollars. And if you don't need the dollars, you have the dollars, which means you can buy stuff. But if you're selling bonds, that means you need the dollars and you're on the defensive. And if you're selling bonds and you need the dollars, what's next to be sold? Will your equities portfolio have to be sold? So nobody wants to be. You're not wrong if you're first out the door. Some margin call references.
Yeah.
You want, and people, if you see a big, a, if you see a rate spike, 6%, a big divergence, which that's what I see as the mechanic for the market now. See a big rate spike, someone dumping a huge amount of treasuries, that would probably in this market encourage an equity market sell off.
Yeah.
Where else are they going to get the dollars?
Well, you got to get them somewhere. And so this kind of like brings me to another point and thing that I've been thinking about a lot lately. Like, um, here is the amount of money that is in money market mutual funds.
Mm.
Like, this is who's buying the treasuries and participating in repo, and what they do impacts the dollar liquidity available to everyone, right? Like, if the money market mutual funds have lots of money, they have lots of money that they can lend. They have lots of money that they can buy treasuries with, because they need to create a return, right? That's why people invest in money market mutual funds instead of putting their money in the bank account. That's why when the Fed started raising rates, all the deposits started leaving the banking system and going to the money market funds. That is because they are able to offer a better rate by investing that money either in repo or in treasuries, or sometimes both. Um, and so
Fun fact:
what I'm thinking about is, once the Fed starts lowering rates,
these will draw down.
this will likely draw down. And the other thing is, it will suck liquidity out of repo. It's going to suck liquidity out of repo. It's going to suck liquidity out of the bid on treasuries.
Look at the top in 20.
Yeah.
No, well, look at the date.
Yep.
Well, how did markets respond?
Boom.
Well, the market. So when this draws down, that means there's your liquidity going into the system chasing assets.
And there's January 09. I mean, when this draws down, you do get it chasing assets. 100% agree with that. What those assets may or may not be, though, is they may not be treasuries. That is the
No, it's
thing.
risk assets. When this is
It's going
up,
to
it's
be
treasuries.
risk assets. And so I think that, and that's the thing that I'm sort of concerned about, though, is that when this draws down, like if I'm a money market fund, right, and I have you know $5 billion or whatever leave today, I have to give those people cash,
That means you have
and
to sell your bills.
you got to
They're
sell your bills. You got to sell. You have to pull your money out of repo to make sure that you have enough liquidity to send that money the back into the banking system, because that's usually where people are going to send it, right? They're going to send it back to their bank so that they can do stuff with it. But
How
like
much
me,
of this is repo versus bills? That would be an interesting one.
I think I'm trying to remember. I used to I know I have seen that chart. That data is available at the Fed. Um like how much of it is repo. I should look at those numbers again. Maybe I'll try to pull those up for next time. But
Because
yeah,
with
I want to
repo,
say repo is, like 30% or less than of what they're doing, but I can't remember the exact numbers.
yeah.
But
Hmm.
so that's just something I've been thinking about. The other thing is, like, I've talked about this a few times, but this is the RRP, right? This is, United States dollar staking, uh and the it's getting drawn down, right? And why is it getting drawn down, though? I think that's important to understand, is why people have been pulling money out of this thing to the tune of $2 trillion almost at this point. Where is it going? Well, Janet Yellen's been issuing a bunch of T-bills. So this is an overnight uh, liquidity reservoir, basically. So this is another place that money market funds can put money. So when that draws down, like, so when people start leaving the money market funds, well, that's going to pull money out of here. When people start uh uh leaving because repo rates are spiking. If repo rates start spiking, somebody goes, "Hey, I can make more money over here in the repo market than I can here." So, here is a really interesting chart that I put together right before this. But look at this. Look at here's the repo rate, and look how volatile this thing is until the RRP fills up. Then it's got a lid on it, right? It's got a lid on it, because if it ever gets too out of control, it'll just get arbed. People will pull money out of RRP, and then they will go into the repo market, and they will lend it there instead. So as this draws down to zero, you're going to see this volatility in repo return. And volatile dollar funding, you know, can cause issues. You start seeing, uh, like, let's see, here we go. And then, so this is the repo rate, right? And this is move, which I thought this was very interesting.
Inverse
Like,
correlation.
this correlation between uh, when the repo rate starts spiking, move goes down. And when move goes up, the repo rate goes down. And I think the easy way to interpret this is that you have these regimes, right? Where you have dollar scarcity. And when you have dollar scarcity, repo rates go up because everybody needs dollars. When you get a whole bunch of treasuries issued, like we are in the situation right now where Janet's just been printing, uh, that leads to collateral abundance, but collateral abundance can lead to dollar scarcity, and then vice versa. If you have too many dollars and not enough uh, collateral, that's how you get the move spike. So it's this balance of, do you have collateral scarcity or do you have uh like dollar funding scarcity?
Next up is an absolute collapse of Move. It's gonna be disgusting. Move is gonna freaking collapse to like 40, and it's gonna be like a monthly candle, and everyone's gonna be like, "What the fuck's going on?" And it's gonna be coming off the heels of $10.8 trillion worth of fresh Treasury bills, and it's gonna be coming on the heels of a 0.25 to 0.75 in rate cuts, and the printer is just gonna get gross. It's
Yeah.
because it's why directionality and cyclicality. Things have been tight, things
Yep.
will get loose. And because of how much new collateral, fresh on the run collateral needs to be added to the system, the cyclicality and directionality indicates the next wave is going to be something like an unprecedented tidal wave of capital.
Yeah. And as we've discussed many times, like the creation of like when you make collateral, right? If I make a T-bill and it's yielding 5.5%, uh I can borrow against that, or better yet, I can lend against that and create new dollar liabilities. Those dollar liabilities then work their way into other assets, because who doesn't want to leverage their wealth for more wealth?
And the kicker is that at the higher interest rates, every lender around the world is going to be scrambling to give you dollar liabilities because they haven't seen these kinds of interest rates in a decade plus.
Mm-hmm.
So they'll be like, here, you got 5.5? Who's got 5.5? Oh, you got five. Oh, you got 5.5 over there. Give me the 5.5.
Yeah.
And just they're just going to be gobbling up, and they'll give you 2 to 1, 3 to 1, 5 to 1, 10 to 1, 50 to 1.
Yeah.
It's going to
I
be
mean,
gross.
and this is the thing that I think the Fed just, I don't know if they didn't get it or what, but like low interest rates aren't stimulative if there's no demand for borrowing and lending. So it's a balance. There's supply and demand, right? When you have low interest rates, sure, I would borrow all the money. Give me all of the money you have at 0% interest. And my demand is infinite at 0%. However, the demand of people to lend to me at that interest rate is zero. And so low interest rates, all they do is stimulate demand if the problem is people want to borrow more but can't, uh but still, I guess, but still can, because somebody is willing to lend to them at that rate. But the fact of the matter is, high interest rates, as the guy lending the money, I'm far more likely to go give you the money at a high interest rate than a low interest rate. And so, where does more lending actually occur? That is really the question. That is R star, as they in Fed parlance. What is the natural rate of interest? They're always speculating on what R star is and where they should have rates set so that that supply and demand balance is
It's organic.
is organic. And the problem is, these guys have no freaking idea where R star is. It's all just wild speculation on their part. The data is questionable at best. They are just making stuff up as they go along and pretending like it's science because they give it a fancy name like R star. But
They have no capacity to stimulate the real economy anymore with interest rates.
they can
Um,
stimulate dog coins.
yes, because this is pure financial economy. This
Yes.
is that's what all the cash in the Eurodollar market. Well, frankly, all the cash that gets printed at some point would chases outperformance. Underperformance chases outperformance. So if there is a growth potential in the real economy, and that's the AI narrative, and that would be like a fusion or alternative energy and something transformative that warrants trillions of dollars worth of capital allocation. But in the meantime, one of the biggest opportunities is alternative and innovative concepts dealing with what's broken. Money and currency is the biggest business on the planet, and credit systems. So that's the shortcoming of the average inspection. It's not. It's the dog coin is malinvestment. So when there's excess currency, sure, there's plenty of that. But the narrative for crypto isn't malinvestment. The narrative for crypto is the same thing as AI and investing in fusion and stuff like that. It's improving a next generation credit system that is more fair, more innovative, that encourages more efficient, more productive financial activity. Uh, but it's by definition literally a new emerging market. It's like a new country coming online, and it's a powerhouse. It has all these sub markets going on and all these technologies being built. That's the biggest shortcoming of people that talk in these markets, is they're not looking at this market as a country.
Yeah. It just it's very easy to draw a box around the inflows and outflows to crypto. And it even has things that resemble capital controls. Every time an exchange makes it harder to get money into crypto or out of crypto, those are capital controls. They behave exactly like the capital controls of people that are trying to get their money into and out of China or wherever. And so if you look at it as this kind of self-contained little box, and the beauty of it is you can see everything happening on chain. And so you can see the flows in, you can see a an accounting of all the assets that are there, what they are, like USDC. We've talked about that many times. Like that is basically US treasuries that have made their way on chain. Dollar denominated assets making their way on chain puts a bid under ETH itself because there's more money in that market chasing that scarce resource that puts a bid under ETH. And so it is an emerging market. And you know,
Of
I
emerging
think
markets.
it's easy to tell going back to the charts here for a second. Like, hold on, let me find my Bitcoin chart. Like, or ETH chart. We'll go with the ETH chart now. But like, it's easy to tell that hey, things are good in the emerging market right now. You know, doesn't take. That's the 3-month chart. That's the Captain Rational special right there.
Things look good, and then they'll look bad. But it's all relative. It's kind of like what folks say about the dollar: the cleanest shirt in dirty laundry.
Yeah. Yep. Let's see. Yeah. I mean, it's I don't know. It's a puzzling thing that we're in right now. Like it's difficult sometimes to explain why assets keep going up. But
No, it's
the other thing to keep in mind though is like, so if you want to take this into stonks, um, like let's pull
oh,
up
that's
the
just stupid. I can't even talk about United States equities. It's one market. It's such a microcosm of the global macro picture. Of course, everyone's piling into it. China's
well, and the thing about this though is that like this market was designed to create exit liquidity out of your paycheck. Like that's what a 401k is for. That is why you can invest your HSA into the stock market to reap greater returns. The entire purpose is to get more passive flows into the market so those that hold the assets can get out. And that's why number go up. But the amount that number go up is largely dependent on those passive inflows.
How are they
And
going to find that this number needs to go up significantly to finance the breadth of baby boomer retirement for
oh,
all the baby boomers?
and
Yep.
that's the thing. That is the thing. I fully expect that at some point when that demographic shift happens, like it is going to take more and more and more perversion of the markets in order to get that number to keep going up to provide sufficient exit liquidity when you have a bigger demographic being supported in exit liquidity by the smaller demographic. And that unless wages
Brilliant.
rise, unless wages rise to meet that challenge, then for once, like the boomers are depending on the millennials getting a raise. Like because for the longest time the millennials and boomers were in the same job market at the same time. And same thing with Gen X. Like Gen X is a smaller gen though. The millennials are a big generation, so are the boomers. They were both fighting for the same jobs. Once all the boomers left though, you see wage inflation rise, and that's going to continue to take place. I think that is a very long macro trend that is going to continue into the future because it's literally the only way that you can solve this equation is making sure that enough money is making its way into the 401ks. I mean, they've tried all the Ponzi economics they can do by making, the 401k like tax advantaged accounts and trying to get more and more of your paycheck into these things. Like they're doing everything they can to ponzify this thing as much as possible to get those numbers up. But
Now you're getting cynical. Now you're heading in the right direction. You are right curving the cynicism.
that's right. You have to get to the other side to where the number will go up because it is foretold. And so will your paycheck. So there's that.
Good stuff, Ben. Very good. Another week of this of trying to peer through the insanity of what so many folks get so much anxiety out of. You see folks frantic on social media, and they not early enough. You got to be early. You don't have to be early. You just have to be right.
That is correct. You have to be right. That is fair.
And you got to get a good price. So that's what I like to talk about. Just get your discounts, get a good price, and that means you're going to be there in place before other people.
Being early is certainly a thing. It is certainly a way that you can reap gains, but it's not the only way. Like
Being
if you're
early,
early enough in enough things, some of them will pan out and you will make gobs of money. But
yes.
being early is not the only way.
See, the problem with being early in my book at this point in my career and my life is it requires work. It requires mental energy expenditure. You got to be in the trenches, spending all this time, and I don't want to do that. So I want to. So literally, look at the trend. The trend is people, millennials say they'll take a 20% pay cut to have a better work-life balance, and that's exactly something I subscribe to. Look, I'm right down the pipe of the millennial demographic and what everyone's thinking.
Yep. Yep. I could go for some less work. That sounds great. Then I'd have more time to be early.
It's 20, 30% on $1 million, and you're good to go. $300,000 a year passive income. Call it a day.
Sounds like a plan. I'll sign up for that.
Yep.
All righty,
Right.
man.
It's a good one.
It's been
February 9th.
it's been a good one. So until next time, everyone, don't be exit liquidity, or do be exit liquidity, because numbers just go up. It's fine.
Just don't provide exit liquidity.
That's right.
Something like
Get yourself some exit liquidity.
get that, get it. Let's try and be we could try and be a little more consistent. I like Tuesday, Wednesday, Thursdays, and that sounds good to me, my friend.
All right, sounds good, man. Here,
Bye,
I'm gonna
guys.
end this thing.
Thanks, everyone.